Imagine this. A physician flies to Hawaii for a 4-day medical conference. She attends 2 CME sessions, each lasting just 1 hour on day one, and spends the next 2 days at the pool and eating poke, and catches one networking dinner on day four before flying back home. And she writes off the entire trip, flights, hotel, meals as a business expense. And why not? She actually went there for the conference, right? There was a legitimate medical education involved. And she heard other doctors do the same thing. And then she gets audited. And she loses a whole deduction. And here's the thing, I say this as a practicing physician and an EA who works with physicians specifically on tax issues. Because physicians are typically high income and often have significant travel expenses, your travel deductions are more likely to attract IRS attention than the average return. And why? Because you have conferences in desirable locations like Hawaii, Costa Rica. You have research trips, speaking engagement, all legitimate reasons to travel. But the line between professional development and a physician taking a well deserved vacation is exactly the kind of line that IRS was built to scrutinize. I'm Dr. Taxter, and I'm an EA with an MST who specializes in working with medical professionals. By end of this video, you'll understand what the tax law actually requires before a travel deduction is valid and why trips that feel completely professional can still fail under IRS scrutiny, and how to structure your travel so that your deduction survives an audit. Because this is one area where the wrong advice can cost you tens of thousands of dollars. So in medicine, we don't prescribe treatment before we have a diagnosis, right? We don't write a script for the drug until we confirm what's actually wrong. Tax deductions work the same way. Before we can even talk about whether a specific trip is deductible, we have to confirm the underlying diagnosis, which is essentially, do you have a deductible business activity in the first place? For most physicians in active clinical practice, you are seeing patients, you're running or working in a medical business. This isn't an issue. Your practice is clearly a business under Section 162 of the Internal Revenue Code. It's continuous, regular, and profit motivated. But this gets complicated fast for physicians with side ventures like consulting arrangements, content creation, and real estate. And the IRS applies what's essentially a differential diagnosis to those activities. So, how much time are you putting in? Do you have expertise in the area? Are you actually trying to make money, or is this a lifestyle expense with the business label on it? If the IRS concludes that it's a hobby, think of it like a false positive on a diagnostic tool. You don't have a deductible business. And if you don't have a deductible business, there's no business travel. The analysis stops right there. So, assuming you clear the hurdle, we move to the next requirement. So, physicians understand the concept of proximate cause from medical malpractice perspective. So, it's not enough that something bad happened. You have to show the negligence act directly caused the harm. So, tax law uses a similar logic with travel. It's not enough that business activity happened on the trip. The law requires that the trip's primary purpose was business. The Treasury regulation under IRC Section 162, specifically Regulation Section 1.162-2B, are clear on this. The trip has to be primarily for business purposes. And courts evaluate that standard by looking at three things. So, first, the time spent. What percentage of each day was actually spent on business versus personal activities? Think of it like an operative note. The court wants an actual account of how each day was spent, not your characterization of it. Second, the substance and significance of the business activity. So, was it directly connected your clinical practice or side business, such as a hospital affiliation meeting or CME course that applied directly to your specialty? Or was it something general or tangential that could have been done anywhere, at any time, more conveniently? Third, the weight of the personal side. Was a leisure component of the trip incidental, like eating the best poke ever because you happen to be in Honolulu Foodland? Or was a poke the real reason you chose a destination at the time? So let me give you a concrete example straight from the Treasury regulations. If you spend 1 week at a destination on business and 5 weeks on personal activities, the trip is considered primarily personal unless you can clearly prove otherwise. That's straight from Reg Section 1.162-2B2. Now apply that to your CME conference scenario. You fly to Hawaii. The conference runs from Monday through Thursday. You attend sessions Monday. You golf and eat Leonard Malasada all day long Tuesday and Wednesday. And you attend one networking dinner Thursday night and fly home Friday. How does that look to the IRS? The ratio isn't in your favor, right? The IRS doesn't really care that the conference existed or that you were technically registered. They care about how you actually spend your time. There's always also location requirement that physicians often overlook. The IRS would look skeptically at trips where the business could easily have been done in a lesser lavish or more typical setting because that suggests trip was primarily personal, even if work happened. So if your hospital system, your partners, and your administrative staff are all based in the US, but you schedule your board meetings in Cancun, the IRS is going to ask a simple question. Why there? Could this have happened in St. Louis, Missouri? If the answer is yes, you have a problem, especially for international trip, which I'll get to. So let's talk about three complications that kills otherwise valid deduction. So think of this section as a complication list on a post-op note. So even when the procedure went well, even when the underlying trip was legitimately structured, these three issues can cause the deduction to fail anyway. Complication number one, documentation. Physicians know that if it wasn't charted, it didn't happen, right? We all learned that in med school. In medicine, incomplete documentation isn't just an administrative problem, it's a liability. The IRS applies the exact same principle to travel under Section 274D. So, Section 274D requires that you document four things for every business trip. Number one, amount of expense. Number two, time and place of travel. Number three, the business purpose. Number four, the business relationship involved when applicable. And those records need to exist contemporaneously, meaning at or near the time of the trip, not when you get audited, not when your accountants ask for receipts in March, during or immediately after the trip. In Mitchell versus Commissioner, a taxpayer deducted over $11,000 in travel expenses and provided hotel receipts and mileage log as backup. The problem was, his receipt showed him in Houston on a date his mileage log placed him in Charlotte. Another receipt said Miami, while the log said Dallas. So the court found the receipts were inconsistent. The hotel receipt had been altered, and his testimony was not credible. And it disallowed the entire deduction. Every dollar, poof, gone. So here's a critical issue that makes the strict substantiation rule under Section 274D uniquely dangerous. Unlike most areas of tax law, the Cohen rule does not apply to travel expenses. So the Cohen rule comes from a 1930 Second Circuit case that allows courts to estimate certain expenses when there's no written documentation, which is quite taxpayer-friendly rule. So in most tax disputes, if it's obviously you incur some legitimate business expense, but records are imperfect, a court can estimate a reasonable amount via the Cohen rule. That escape valve is explicitly blocked for travel. So if your documentation doesn't meet the strict substantiation standard, the IRS can deny the deduction entirely, even if the trip obviously happened and clearly had a business component. So a physician specifically, keep a simple travel log. Think of it as a soap note for your trip. So include date, location, business purpose of the day, who you met with, and why, and also business relationship. It takes 5 minutes. So it's a difference between a deduction that survives and the one that doesn't. So complication number 2, family travel. I see this consistently with physicians. They take their spouse to a conference, and their spouse helps them with registration, sit in on a dinner at Paella fish market, maybe manage some logistics, and the physician deducts the spouse cost as a business expense. It almost never holds up. So Section 274M3 sets a high bar for deduction for a family member's travel. So family member must be a bona fide W-2 employee of the business, and their presence must serve a genuine business purpose at the specific location, and their expenses must independently satisfy all other travel requirements. So think of it in clinical terms. Helpful is not the same as medically necessary, because insurance companies won't reimburse for treatments that are just merely helpful. They require medical necessity, right? So the IRS applies the same logic to family travel. A spouse who attended a conference dinner, took notes in a session, and helped carry material is helpful, but the test is whether their presence was necessary, whether the specific business purpose of the trip required them to be there. So courts have consistently denied the deductions in cases involving spouses who perform just administrative or social functions on the trip. The reasoning is the same every time. The work they did was incidental and could have been handled by the physician alone or someone already employed. Putting a spouse on a payroll or giving them a title does not necessarily change the analysis. The courts care about what they actually did at the location and whether it was genuinely required. Treasury Regulation Section 1.274-2 and multiple cases construe bona fide business purpose narrowly. So mere social or incidental clerical assistance usually fails this test. So if your spouse genuinely runs your practice operation as a manager and traveling with you to a partnership meeting or business negotiation is a substantive part of their role, that can work. But it requires real documentation of their actual function, not just a paper trail of employment. Complication number 3, international travel. Physicians travel internationally for legitimate reasons like global health work, international research collaboration, like speaking at foreign medical institutions, specialty training only available in certain countries. Those can absolutely be deductible. But Congress was not naive about the personal appeals of international travel, and they built in specific additional requirements that apply, regardless of how legitimate the business purpose is. Under IRC Section 274C, even if your international trip is primarily for business, your deduction may be limited unless one of several exceptions apply. For example, the trip lasted 7 days or fewer, or you spent less than 25% of your time abroad on personal activities. If neither applies, you can only deduct the portion of your cost that corresponds to your business time. So, a 10-day trip where 4 days were personal, you're roughly losing 40% of your potential deduction, regardless of the business purpose. So, under IRC Section 274H, there's a separate requirement for foreign conventions and meetings. So, you must be able to demonstrate why the business activity needed to take place in that specific foreign location and could not have been reasonably been held in the US. So think of it like justifying a procedure to an insurance company. You don't just say my patient needed the surgery, right? You also document why this approach, why this surgery, why this facility, why now. So IRS wants the same level of justification for why your board meeting or medical conference had to be in Costa Rica rather than a domestic city. So physicians doing genuine global health work, international research, or specialty training that only exists in a particular country, this can be well documented and defensible. But if all participants are US based physicians and the same clinical discussion could have been discussed at a domestic academic medical center, you may have some difficult time defending the international deduction. So here's the bottom line. And I want you to hear this the way a consultant speaks to you, a colleague, directly and without softening it. So physicians are generally high income earners, and high income earners generally get audited at higher rate. And travel deductions are one of the first places an IRS auditor looks, because this is one of the most commonly abused deduction in the tax code. And because a line between physicians' professional life and a personal life, the conference in nice cities, CME credits that happen to be in Hawaii in January, where the best pokés are found at a grocery store, is the kind of lines that invites scrutiny. So the IRS is not evaluating your intent, they're evaluating your facts. Just like a medical record tells a story of a patient encounter, regardless of what the physician remembers, your documentation tells a story of your travel deduction. If the record doesn't support the claim fails. Here's what actually works. Trips where business is a dominant purpose from departure to return, where the location is reasonably required for the activity, where your documentation shows the time and purpose of each day contemporaneously, and where you understand the additional rules around family members and international travel before you book, not after you get a notice from the IRS. So travel is a legitimate and valuable deduction for physicians who do it correctly. But correctly means meeting the legal tax standard, not meeting the bar that someone online told you about. So the difference between those two things is a difference between a deduction that survives and the one that comes back to you as a deficiency notice with penalties attached. If you found this useful, subscribe. I put out tax content specifically for physicians and dentists.